We want you to plan for success. Welcome to Planning Matters Radio.
Hi, Peter. Very good to see you. We have great advice for anybody who is retiring in a bear market. We need to be aware of something called sequence risk. As you know, stocks officially entered bear market territory earlier this year. The 60-40 portfolio saw the second worst 6-month period in the past 50 years, with both stocks and bonds declining. So anybody who's retiring right now, they're facing unique challenges. And so, of course, if not handled correctly, you could jeopardize your retirement savings because of something that's known as sequence risk. What is that?
Yeah, well, not just bear market, but, based on whose definition, we entered into a recession by the technical accepted textbook definition as well. I think retiring into a bear market or a downward market is going to be unnerving regardless, right? Let's just put it out there that it's difficult when you are changing fundamentally how you are working with your money and how it's working for you. And we have economic difficulty on top of that. But we are fundamentally changing, in fact, reversing our behavior with our money. Instead of making contributions to our investments and living off of our work ethic and our paycheck, we stop the paycheck and now are living off of our savings. And during a declining market, we need to be especially careful. In fact, there are some specific steps that you should take, and there are some circumstances that create the necessity for those steps that I think that we'll go over here when we look at sequence of returns risk and reverse dollar cost averaging. So sequence of returns risk says that the order of returns matters. Now, if we were neither making contributions to our investments nor taking withdrawals, then the order of operations, the sequence of returns, actually does not matter. You could flip it upside down, top to bottom. You could shuffle the returns over a given period. As long as you kept the same returns, then the outcome, the amount of dollars that you have at the end, would in fact be the same. However, as you begin to make withdrawals, the order that those returns happen in does become important and in fact determines your outcome. And if there are negative returns early on in your retirement, it can be pretty disastrous. It can actually impact the entire projection of your retirement. And so let's look back at a couple examples. If somebody had retired at the end of 2006, and so the next couple years, 2007, 2008, 2009, they were experiencing negative returns and making withdrawals at the same time, that was a pretty difficult retirement. On the other hand, if somebody retired in, say, 2010, and the next decade was an upward moving market, it made retirement all that much more simple to plan and prepare and to make those withdrawals and create the income that you need.
Right. Well said. And especially when we look at this example, I think it's interesting to think, oh, yeah, your money is going to have a 13-year gap. One runs out that much sooner. And I think there's a lot.
And those are the same returns. This is sequence of returns that we're talking about. We just reversed the order. We went from positive returns early to negative returns late. Your money lasts a very long time, much longer. But if you take those same returns and reverse them and have the negative returns early, you can see from that chart that your money runs out much quicker.
Right. Yeah. It's interesting to look at it that way. Something else that I was surprised to learn, you would think that a 50% loss, you would need a 50% gain to make that money back. But that's not how the math works, Peter, right?
Yeah. And maybe people have seen this or experienced it in their lives, but it's the difference between linear averaging and geometric averaging. But the loss that you incur does not mean that you only need to make the same gain in order to make it up and become whole. And if you take a 20% loss, you need a 25% gain on your remaining money to get back to where you were. If you take a 50% loss, you need 100% gain to get back to where you were. And to take this a step further, Erin, it is why I believe that advertising, past performance of mutual funds is one of the biggest fallacies of the financial world. And I know numbers are a little complicated, so I want to give a simplified example. Let's take a 3-year period of time where a mutual fund advertises an 11% past performance rate of return. Okay, so you start with $100,000. In the first year, you lose 50%. So now your 100,000 is 50,000. In the second year, you gain 50%. So now your 50,000 is 75,000. And the third year, you gain 33%. So 1/3 of 75 is 25. Now you are back up to your original starting point of $100,000. But let's average that out. -50 plus 50 is 0, plus 33 is 33, divided by the 3-year period. That's an 11% average rate of return past performance that a mutual fund could advertise when you have the exact same amount of money that you started with. It's really why I have a hard time in putting faith in those past performance numbers sometimes. We really got to drill down and look at and evaluate how those returns happened.
Yeah, it's wild when you break it down like that. That's really helpful. Thanks, Peter. So let's then tick through a couple of options that people can do instead of tapping their portfolio. Number one on your list is turn to your savings.
Yeah, I mean, turn to your savings during down times, but nobody likes spending their savings. You know,
Right.
I hear this as a strategy. Well, I'm going to keep some of my powder dry, keep a couple years worth of living expenses in cash. And during a down market, it can be your savior, but you're still going to have some emotional kind of bad feelings in your gut about spending through your cash. Plus, in good markets, that cash is missing out on the potential for growth. Rein in spending and knock out and control debt, I think, are two things, in addition to turn to your savings, that we should all be doing regardless. Even in good markets, we should try to control our spending, which is your best asset for a successful retirement, is keeping spending under control. And one of the ways that you can do that certainly is to knock out and eliminate debt, because
Right.
debt payments are a large part of most people's budgets, actually.
Rein and spending, always at the top of my list, Peter. So those are kind of the tried and true methods that I think everybody knows at home, but there are a few more advanced math options here that you want to walk through. Number one is weighing your Social Security options, which is always important. We've talked about it before, because the sooner that you claim those benefits, the less your lifetime benefit.
Yeah, and I think you need to think about these strategically. You need
Right.
to be proactive and ahead of time with these last two. But yeah, absolutely. Weighing your Social Security options. If you can delay Social Security, that means more money in the long run. And the reason it's advanced math is because even for married couples only looking at claiming their individual benefits on whole year increments, there are 81 potential different combinations for that timing of Social Security benefits. So again, like we talked about with sequence of returns, timing matters here. We really need to go through those options ahead of time, think through them, and then not look at Social Security as though it's in a vacuum all by itself. We need to incorporate that with the rest of our retirement income picture, because it is going to have a cause and effect on how much we thereafter have to draw from our portfolio. So the online calculators are great, but they put Social Security alone as though it's on an island all by itself. It's not. It's got to be incorporated. It's a piece of the puzzle. The second is have a written retirement income plan. And I have seen studies that show that the vast majority of Americans have concerns about running out of money, that it is like one of the top fears in retirement. But I've also seen studies that show almost the same percentage do not have a written retirement income plan. At Richon Planning, we call it a GRIP. Get a grip on your retirement, a guaranteed retirement income plan. And guaranteed income is from Social Security and pensions. And there are other alternatives where you can actually go out and get contractually guaranteed lifetime income, but you want to have a reliable stream of income. And then you can be more confident in retirement and maybe better avoid sequence of returns risk without having to drain down a large amount of cash that you haven't had any growth on for a period of time.
Yeah. Well, I like your point about having a conversation about these things because there is no cookie cutter answer. So I think that a lot of people are probably wondering if they are retiring right now or plan on retiring soon, if
Yeah.
this is the moment when they should go back to work or even delay their retirement. That must be a really bitter pill to swallow, though.
It's a tough one.
Mm,
It is. And the reality is that retirement is financial well-being, financial security, quality of life is peace
mhm.
of mind, is the reliability of income. And when your assets are in the market and it's fluctuating or going down, you may not have that peace of mind for stability and for dependability of your income stream. Listen, life isn't all financial though. I mean, you've got to balance, you've got to weigh the financial aspects very, very carefully because you're considering walking away from your income earning potential. But you also have to balance your mental, emotional, psychological well-being as well. And all of those things can be vastly improved if you actually sit down and have that written retirement income plan and get a grip on your retirement. I would say that it's not a must that we delay retirement or go back to work. It's simply suggested, highly and strongly suggested, that you sit down and look at your finances and really evaluate that income plan, and also carefully examine all of the assumptions that it's based on. You
Mhm.
know, eliminating risk is about controlling variables that can negatively impact us.
Mhm.
Down markets, rising inflation, rising taxes. These things are all variables that a lot of plans, I'll put that in air quotes, a lot of projections have some variable of assumption that we really need to carefully examine and say, well, what if that assumption turns out to be wrong? Are we better off or worse off than we thought?
Right. Well said. Peter, this was very helpful. I'm sure that a lot of people watching this would appreciate, again, having this conversation with you. If so, what's the best way to reach you?
Yeah, give us a call at Richon Planning, 919-300-5886, 919-300-5886. You can email me, Peter at RichonPlanning.com. It looks like richonplanning.com. It's my last name, Richon. Peter at RichonPlanning.com, or the website, RichonPlanning.com.
All right. Peter, thank you.
Always a pleasure. Thank you.
This has been Planning Matters Radio.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookzone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.